Good afternoon. We're live. Thank you for joining us. Welcome to Red News and RE Journals Breaking Through the Disruption. Thank you again for joining us. We've got a great group and panel today. Although I can tell you, not many people want to sign on and listen about taxes, but all four of these people have tax deferral strategies that are going to help you. And a lot of them are more relevant today because of the COVID outbreak, the shutdown, the impending potential recession that we have. All this is really good stuff. It's going to help you out right now, either put cash in your pocket or make a difference. So pay attention. This is good stuff. I'm going to start with some housekeeping items. Again, thank you. Thank you to our sponsors. Red News is part of a bigger group now called RE Journals. We have 6 publications. We had planned on doing 14 events this year. 104 events this year around the Midwest and the nation. We have had to completely pivot and do these online. It's been a challenging time for everybody, including us. We couldn't do this without the help from our sponsors. So a deep thank you to Ranger Land and Minerals, Asset Preservation, SAG Group, Creative Real Estate Strategies, CSSI, and SIOR. We need all of these people to make all of this stuff happen. So a deep thank you to you guys, and I look forward to this to this webinar. If you're online, you're watching right now, if you have connection issues, the easiest way to fix it is at the top of your screen, there's a reconnect button. So if somebody's picture freezes up, or if you're saying in the chat room, hey, I can't hear any sound, click that reconnect. That'll fix 99% of your problems. I'm showing 5 bars, so our dedicated server for this webinar is looking 100% right now. So it shouldn't be me, it should be you. No offense, not like we're dating. But that's how you're going to fix your reconnect. If that doesn't work, then make sure you're using Google Chrome. If that doesn't work, then just close your browser out, reopen it with the link we gave you. That should fix it. We have a chat room on the right. I want everybody to go in there, put in your name, where you work, where you're from, and you can network with these people. I also see Jerry Wilkins threw his email in there. That's great, because now, hey, Jerry, I haven't seen you for a while. Now I got your email address. Polls are also right below your chat window. I'll put a poll up in a little bit, and then that's going to turn red when you see that kind of get active, and then go in there and you can answer that poll. We have a YouTube channel now. So Red News, RE Journals YouTube channel. It's rejournals.com/video replay. That's where we'll have a replay of this event. So you guys that are speaking, if you want to send it out to your friends or kids, hey, look at your dad's on YouTube now. That's the link. If you have to drop off early, that's the link to catch the rest of it. Feel free to use that and pass that around. So again, today we're talking tax strategies made more powerful by CARES Act. We're going to, as soon as I can get this to stop, we're going to sometimes I try to do a lot of roundtable type stuff. This doesn't quite fit that box really well. What I'm going to do is I'm going to have Greg start us off. And Greg from Asset Preservation is going to give us a little bit of background. Greg, you got about 10 minutes. So quick, introduce yourself. I'll bring your slides up.
Okay, I'm Greg Lehrman. I have exclusively focused for the last 25 and a half years on 1031s. And of course, this talk assumes you already know about 1031s. We're squeezing a lot of topics into a short period. I'm just going to talk about what's new with 1031s. Legally, and then also what's new more from a trend. So with that, what's newest? There's an IRS extension that's just going to last for a very short period of time. It does help people right now doing 1031s. And then I'm going to talk about replacement properties that come with social distancing. As a lot of you may know, some of you may not know, just a quick recap, of course, Section 1031 for almost 100 years now. Next year will be the 100th year that you have been allowed to sell any real estate in the United States that you have been using in your business or holding for investment, and defer all of the tax if you reinvest all of the equity and replace all the debt into any other real estate in the United States that you're running any business out of or hold for investment. It's called like-kind property. It's not like-kind property. One guy said, like-kind property means if you like that kind, buy it. So it's very broad. Normally, these are the deadlines that you may all be familiar with. To do actually structure an exchange, it's real easy. You call a good qualified intermediary like ourselves before it closes. You've got to set this up before it closes. And it's really just like a retirement account rollover since 91. You know, from 1921 to 1991, exchange actually meant exchange. It doesn't really mean that anymore. You just sell to a buyer with exchange documents and then have someone like us hold the funds. And that first time period is the normal time, 45 days. The normal time period is you got 45 days to put together a list of candidate properties and a total of 180 days to close on them. So that's all it is. You're just selling with exchange papers. Your money goes to a QI. You identify your potential replacement properties within 45 days, close within a total of 180. Of course, it's not 45 plus 180. We have a brand new deadline. It came out exactly 3 weeks ago. It's the weirdest deadline the IRS has ever issued. In the past, people have gotten deadlines for 1031s and other things when they have been in a county that was affected by a tornado or a hurricane or a flood. And when the federal government declared a disaster for certain counties, you would get extensions for both of the deadlines on 1031s of 120 days. So your 45-day period and your 180 were moved forward by 120. This is very unusual. What happened here with this extension is just whatever deadline falls between April 1st that we already passed until July 15th. Whatever deadline in that time period gets extended to July 15th. It's very unusual. So if your 45th day, say, was going to come up to tomorrow and you're freaking out because of this market, you can relax. And now you can take all the way until July 15th instead of have a deadline of tomorrow. What's weird is it doesn't change your 180 day. It still helps. It helps. It gives you quite a bit more time right now to identify, but it didn't change your 180. Or let's say you already identified and that was a while back and it was your 180 day period that was coming up. That's extended to July 15th. So for some people, it is a huge benefit. It is going to be pretty short term if you think about it. We're already almost into May. Well, June 1st, once you get to June 1st, the 45th day would have been July 15th anyway. So it's really for a short period of time, but some people will benefit. And if some people were concerned about selling now because they have to find a property within 45 days, at least now you've got July 15th because of this market. So that's it. They may add to this. They may clarify this. There are a lot of questions that were raised by this. We don't know. So you want to be paying attention to this. But that is the extension that we have right now. So I have this diagram. If your 45th day was before July 15th, now it moves out to July 15th. Or if it was your 180th day that fell before July 15th, that's now July 15th is 180 days. But remember, they don't both move. It's just whatever one would have happened during this period is moved to July 15th. I mentioned like-kind property being so broad. So I'm going to end with the three things that you've been able to buy for a while and not pay and still defer taxes, but it's even more relevant now. There's pretty much three things you can buy that most people never see, they never touch. And that's been the beauty of them even before COVID-19. You can sell high maintenance real estate and go completely or almost completely no maintenance by either buying a triple net lease property like a Walgreens. They're all owned by older 1031 investors who've never seen them. A Delaware statutory trust, which is buying a fractional interest in a building. So you have to buy those from a registered investment advisor. And those are illiquid, but they're also passive and they're easier to identify. DSTs and oil and gas are both, what they have in common is they're a lot easier to identify at the last second. What they have not in common, DSTs, you're totally stuck until the building sells, and you have no say in when it sells. With oil and gas, if you outright buy the royalties, then you want to sell them, you want to sell them. So that's the difference. And that's a perfect segue to our oil and gas guy that's going to tell you more than I have about oil and gas. I just want you to know it is an option. Most people don't know it, and it can be perfect for some people. So I'm going to turn it over. You can call any questions with 1031s, and yeah.
I'm going to go back, Greg, just for a second here. So triple net lease, you're saying that's a good property that's usually passive, like a standalone type property with a retail or some type of tenant similar to that in it?
Yeah.
A DST, I want to hit this real quick because we've got two Bobs on the line, and Bob number two, what he's working with is also as the initials DST, but it's a deferred sales trust. So that's another option. It doesn't go through 1031. So I just wanted to make that a point. And the oil and gas. So I'm from those of you that have been watching other webinars. I'm from Minnesota. We do, North Dakota's not too far away, and we got some oil and gas up there. But I'm telling you, I'm starting to get sold on this as a 1031 replacement, because if I'm in Greg's shoes, matching dollars is hard, right? On 1031s. Right. So the things like an oil and gas, you can use to get the right dollar match. I think that's probably the coolest thing out of all of this. You can buy 100% into it, or you don't have to, right? You can buy a triple net property with half your proceeds, and then oil and gas, and diversify your portfolio with the other half. I don't think people talk about that, right?
Right, exactly. You're right. That's very good points. Those are very good points. You bet.
So, okay, I didn't want to take away Greg's contact info for too long, so I will throw up on the screen everybody's kind of bio as they're talking, and make sure that you have their contact info in case you want to talk further about that. That was great. Well, you already tried to pass it to Bob Baker. So I'm just going to let Bob. I'll let you go. He's got a video I want to play, so just hold tight. I'll get that queued up. If everybody online looks, he's got the nicest view of anybody I've done a webinar with over the past 3 weeks.
America is in the middle of an energy renaissance. Thanks to new methods and exponentially improving technology, energy companies are reinventing older oil fields, maximizing reservoir potential, and discovering a massive volume of untapped reserves right here at home. This boom has put the United States on the road to energy independence
for the first time since the horse and buggy.
It has also opened the door of opportunity for private investors. Oil and gas royalties are providing an unparalleled vehicle for diversity, growth, and stability. Royalties are nothing new.
They have been
handed down through generations. Families have been receiving royalties from oil and gas for over 100 years. Until recently, they were only made available to institutions, large endowment funds, and ultra-high net families.
Now,
the private investor can own the same type of assets without having access to hundreds of millions of dollars. Oil and gas royalties allow participation in the energy sector without the risk of drilling and owning wells. Here's how they work. When oil and gas is produced, mineral rights owners receive royalty payments for the production where drilling is performed on their property. Payments are sent directly to the royalty owner's mailbox every 30 days. Royalty owners don't pay any costs for the operation or development on their property. They don't assume any liability whatsoever. They just collect cash flow. The drilling company and operators handle everything. For an investor, these royalties provide incredible returns with zero management or maintenance. This tax-sheltered income is not tied to stock or real estate markets. There is simply nothing else out there like oil and gas royalties. For more information about acquiring oil and gas royalties, visit us online at rangerminerals.com.
That's a good high-quality video. That explains everything. I got to get one of those. All right, Bob, we're turning it over to you. Make sure you talk loud and we can all hear you. Oh, turn your microphone back on. Up in the top, a button next to your webcam button. Keep trying. One more time. There. Oh, and then he froze for a second. Has anybody else seen it? Keep, if you can hear me, Bob, keep talking. Yeah, I can't hear you. Do you want to do me a favor? Do you want to close down and come back in? I'm going to skip ahead and try to get Bob 2 on the line, and then we'll come right back to you, okay? So Bob Baker, the link that Katie sent to you, log out and push that link again. You should be able to come back in, and we'll get to you. Okay, thanks. So Bob, the DST, Bob, which doesn't stand for Delaware Statutory Trust, what does it stand for?
It stands for Deferred Sales Trust. So welcome. Good morning or good afternoon, depending on what part of the country you're in. So nice to meet everybody here virtually. Hope everybody's healthy.
So Bob, do you want to get your PowerPoint up? I got it up. Do you want to go through this?
Yeah, okay, no, great. It's perfect. Perfect. Thanks, okay. Guys. So just so everybody understands, the Deferred Sales Trust is just a made-up name. It's not the Delaware Statutory Trust. It's really something that we've been doing for 24 years, long time. And we've done, literally thousands of transactions. We've been reviewed by the IRS 14 times. We've had no change audits. Matter of fact, the estate planning team over here on the right, you'll see, I'm the CEO of the estate planning team. And our goal here is to tell you a little bit about our company and give you some background on what the DST can do. So, we have trustees across the country. Our goal is to have trustees in all states, as well as law firms across the country. The DST has gained a lot of momentum. So just so you guys understand, it's we're an alternative to the 1031 exchange. We like 1031 exchange. We think it's great. We just think that at some point in time that exchanges, valuations and cap rates get too high. And people want to get out of real estate at some point in time, and in business sales they really don't want to pay their tax, and again they don't have the right to do a 1031 exchange. So we think that we have a great solution. So the DST is just an installment sale. We have an installment. Installments have been around almost 85 years, longer than 1031, longer than a lot of the codes. So we operate on a very safe structure. A lot of people don't know much about us, and they all think that this can't be legal. It's too good to be true. So that's a typical common thing that we get on phones. But they need to look at what we do and how we do it, and understand the laws behind it, and see our audit history. And again, the IRS has reviewed our structure, so we have never had a problem at all. Not one problem with thousands of transactions, and we're gaining a lot of momentum. So that, really the big thing that we're seeing is the baby boomers are getting older. Taxation, is a big issue. And most states are really not excited about, lowering their taxes. And there's some that are eliminating 1031 exchanges. And, there's a lot of changes that I think is coming with the amount of problems that we've had with the amount of stimulus going, a lot of money. How are they going to get this money back? So there's possibilities of even a step up going away. There's possibilities of 1031 going away. There's a lot of stuff that could be overhauled down the road. So you all have to be cognizant of that. We're in a low interest rate environment. Obviously, real estate is highly priced, but then that might just change with this market. So, but it may not change fast enough to be able to do a 1031 exchange, because you've got 45-day rule to ID. And so what are your options here is you can just hold on and not sell. You can do a 1031 exchange if you can, find a replacement property, and great. If you do it, that's wonderful. But the concern that we have is if you go down the road of down a 1031 is that you can't find it within a time period that you need, and you fail on your exchange and the tax becomes due. Or you could do a deferred sales trust, which is an installment, or you can sell and just pay your taxes like a lot of people. So just so understand how this works, really simple. The step one is you have an asset to sell. Over here it says asset to sell, and you own it. You've got a low cost base and you've got a gain. Maybe you've depreciated your property. But so what we do is, obviously figure out your basis, figure out what you're going to sell it for. And we have a trust that gets created called the DST. Our tax attorney would represent you, to do this. They would create this at no charge up front. They would do all the legal work to get everything done. And if you don't close, there's no obligation there's no liability. So just step 2 is the trust gets formed. The trustee is an independent trustee. We have to work with independent trustees. We have them across the country. They're usually CPAs or attorneys. They're very skilled. And again, they understand the DST very well. And this is what they do. So the trust and the trustee would buy your asset for the price that you want to sell it. That establishes a new basis in the asset. That basis would be what we're purchasing it for. And let's say your basis is $1 million. We would buy, and you want to sell it for $5 million. We would be buying under an installment for $5 million. So our basis with the trust would be $5 million. And now we turn around and sell it to the buyer that really has $5 million ready to buy it, from the trust. Now the key is the trust would be the seller, not you individually. You would sell it to the trust, the deferred sales trust, under an installment contract. So a promise to pay back from the trust to you all the money at some period of time. Usually 5-10 years, can go longer, but the idea is that you sold it for $5 million. You're going to carry back paper against this money when it becomes liquid. So the asset would transfer to the trust, and then it would end up in the buyer's hand in exchange for the cash. So ultimately, the cash would come in to the trust, and then it gets invested in what we call client-approved DST asset allocation. So we would have invested in safe, conservative investments that you believe are that you deem as appropriate for yourself, and more importantly, that becomes your collateral. Better, versus the traditional where you would just finance the asset that you once owned. You would actually, in this case, get rid of that. The trust would dispose of that asset, and now it would be liquid cash. So no better collateral than the liquid cash, and then you would have a very diversified installment sale against, that assets that are non-liquid, or that are liquid versus a traditional where it's, you have to run the risk of getting your own property back, and nobody's going to do 100% financing on your property. You're going to need to take some cash, and you're going to have to pay tax on that. So we just want everybody to understand this, and we're going to be able to send out the slides so that we can go in more of a detail for each and every one of these professionals watching this. I just want you guys to understand that the DST has a lot of benefits: flexible payment options, liquidity, diversification, enhanced retirement income because you're going to have more money, maintains family wealth. We can actually deal with estate tax planning, and then we can also go rescue 1031 exchanges. So we can send it to an accommodator, and if you fail, because we want you to try to do a 1031 exchange if you want to do it, but if you fail, we can default into a DST. Which is great. And more importantly, for people that want to go back into real estate, we can go back into real estate. If you want to go back into real estate, utilizing the DST money, there's ways to do that. We'd like to show you so that, for real estate agents, we're not here to take away your client. We're here to actually give your client the ability to have a runway where they can have a longer runway than a 1031 exchange, and then certainly go back into real estate. And for the cost segregation side of it, cost segregation is great. We believe in that. We like that. And you can certainly buy a new piece of property and get a new depreciation schedule when you buy something, which you can't do under a 1031 rule. So when you buy a property and you exchange your depreciation, unless you exchange higher to a higher amount, you're not going to have any more depreciation. In our seg, what we go from a DST, and then we can actually move into buying more property down the road, and when that gets purchased, you get a brand new depreciation schedule, and then you throw in cost segregation on that. Boy, do you have something even better than a 1031 exchange, and this really excites people going forward. So we'd love to explain how that works in detail for you. Again, on that $5 million illustration, real quickly, you'd owe $1,484,000 on a $1 million basis, so pretty substantial gain. So we'd like to make sure that at least your client has a $100,000 gain, or $100,000 tax due. Somewhere between 75 and 100 makes sense to do this transaction. So again, we think there's a lot of great things that the DST solves for. More importantly, we want to help. If you're a real estate professional, or you're a client, or you're a business broker, or whatever your profession is, it's our goal is to help you, find ways to help your clients. Because again, if you want to get listings, you have to differentiate yourself from a traditional commercial real estate agent. Everybody's trying to do, move clients into a cap rate that makes no sense. And then obviously with the COVID, issue, these underwriting things are going to change dramatically. And I think it makes a lot of sense for you guys to kind of, get your clients in a better position where they're liquid, diversified, and then they could take a year or two off or a month or two off, and then go back into real estate at better cap rates. So again, our history is it's a 453 transaction. The total DST time that we've ever been is 24 years, reviewed by the IRS. We have national tax law firms. We also provide audit defense at no additional cost. Our tax attorney stands behind it. Here's one of the big things for each and every one of you as real estate professionals, business brokers. The easiest way for us to work with you is we actually create a website for you and a way for you guys to get on the EPT, which you see at the bottom, myept.com. There's a way that you can get a free website that all you have to do is sign up, and it actually creates your own portal for your own personal website. It actually gives you an illustration calculation that for your clients can actually see what the DST can do versus a tax sale. So you would get on the website, get your own website, and it's free. And then all that information would be run right up to our tax team, and we would help you close it so you can actually market this DST. We have a brochure and everything that can all free to give to your clients to be able to help them understand the DST so they can actually get an illustration, share it with their CPA, share it with their tax attorney or personal attorney, real estate attorney, so they can see it. So this is really what we do. David Fisher is one of our brokers that works with us with Creative Real Estate. This is his contact information. David would be assisting you. Certainly, I would help you any which way we could possibly do to help your business. And our goal is to help you grow your practice and give alternatives to the 1031. Again, we love 1031. We think it's a great structure. We think it's a great strategy, but at certain times, the 1031, it can be risky. I mean, go back to 2007, and then if you exchange into property at that time, what would that have done to you? I mean, that's our concern. We want to be able to give you ways. And then if you're getting too old, I mean, I don't think the 1031 companies out there want, an 80-year-old person to have to exchange. I think there's a risk for that. So the idea here is to keep your money safely, diversified, liquid, and tax deferred, and then certainly, look at all the options available, for your family. And again, if you pass away, you don't get the unlimited step up. Just a lot of questions about that is, with real estate, you can get an unlimited step up, or even with stocks. But with this, if you sold it, you've sold it. But the tax does not come due upon death, just so you know. So your family can inherit the note and keep the deferral going on and on and on, and then get paid back based on the schedule. So I want to thank everybody here. I know there's going to be some Q&A. I don't know if that's going to start now or not, but I really appreciate everybody being here and our sponsors as well for bringing this show together.
Yeah, for sure, Robert. Stick around because we'll do Q&A at the end. But I want to put in a quick plug for you. I don't know if I admitted this to all of you, but back in the 90s, I was a tax geek, and I worked at the tax department of a national accounting firm. I was part of their national office. We were doing deferred sales trusts in the 90s with a lot of zeros behind them. I mean, the big players across the country have been doing this for a long time. It's nothing new. It's just hasn't always been advertised. Does that sound about right, Robert?
Yeah, it's a highly technical strategy, but again, what you want to see is you want to make sure it's suitable for yourself. And you want to make sure that you understand it clearly. And that's our job, is to explain it, educate you. And then you could also do a partial exchange, because if you don't, with an exchange, it's an all or nothing, or you've got a boot issue. I mean, you could actually put the boot in here, or, combination, deferred sales trust combination, 1031 exchange. So we want to be able to provide you as many options as possible. I think everybody here on this line is here to help you and give you good ideas from a tax deferral. And then again, diversification is the key that we think is very important about people with the amount of volatility in this world right now. I hope that all makes sense.
That's very good. Thank you. Stick around. I want to get back into 1031 right now because I believe Bob can talk to us. Bob 1 can talk to us now about mineral rights as a 1031 option.
Hi there. Good afternoon, Bob.
Yes, it works.
All right. Thank you guys for joining us. Thanks for inviting us. Glad to be a part of the webinar. I'm Bob Baker out of Dallas, Texas. I've been in the 1031 business for about 20 years now, done several $1 million in exchanges. My properties are a little outside of the box. Typically what we're trying to do is deliver the property to the client. This is truly a triple net lease with growth. I want to deliver it to the client where they're starting out somewhere around a 15% yield. For a lot of folks, that's a high number. They automatically say, why isn't everybody doing it? Too good to be true. Why would you sell it? Those are typical questions we're asked. Ours is pretty simple. I have the title. I'm the owner of the property. I have the historical monthly checks. So third grade math, if you own 10% or 20% of whatever that check is, I think we just got a check in for $220,000 for the April payment. So basically, we're in the cash flow business. I buy and sell triple net lease properties. They're in the form of a mineral deed. Been around for over years. There are no tenants or toilets to deal with. There are no expenses. This property also does not cost you any property tax. Property tax will be paid for by the surface owner. I'm the mineral owner. I own everything under the ground. I'm to all depths. So I have a property down in South Texas right now. There's 53 wells producing, produces several $1 million per month. And as they were speaking on the 1031 exchanges, I can accommodate any dollar amount, starting somewhere at $50,000 to 5 or 10 million, whatever the needs may be. Could be an odd dollar amount. A lot of times folks have boot money left over. Could be a cash investment or 1031, not necessarily only 1031s. We also have a lot of folks that want to own a high net yield property inside of their IRA. So those are kind of the three avenues we fund it. I do record the interest into the 1031 participant's name, so they have 100% control over it. If they ever do want to sell it, it's a very liquid asset. 15% of the revenue stream is also tax-free. So you get a tax break on the monthly cash flow. So sometimes we'll have a guy that may have $129,000 left over. Don't want to pay tax, not enough to buy a house. I'm the parking place for those funds. Or they have $1 million. We have a lot of $1 million transactions, and they like $150,000 as kind of starting point. On my properties, we're making you money two ways. These are growing revenue streams. So I had a fellow that invested $250,000 with me about 10 years ago. So far, he's collected $1 million in monthly cash flow, not one payment, but over a 10-year window. Still collecting, I think, around $5,000 or $6,000 a month. No tenants, no toilets, no expenses. We are the closing agent, so there's no origination fee or management fee or transaction fee. Whatever dollars are placed, that's what you're going to base your return off of. We've got a lot of folks that are traditional brick and mortar owners that are wanting to get into something that's more of a passive revenue. They can 1031 into my property. They can 1031 out. Again, no fees to enter or exit. They do get title. It's recorded at the county level. They do get a monthly revenue stream, and most of my clients set this up as an ACH. So the money actually would wire directly into your bank account every month. If they want a hard copy check, they can get that also. But it's an alternative to a traditional brick and mortar. Somebody that doesn't want to own an apartment complex or a Walgreens or a CVS with a 5 or a 6 cap, I'm starting you off somewhere, in the 15% range or higher. I own some of the properties. So also I've done some historical retro pay, if you will. So some of the properties I've owned, let's say since January, I would include them in a January, February, March payment. They get paid again in April and May. So right off the bat, they're starting at a high yield, well above what you're going to see on a traditional brick and mortar. I've got one of my clients that builds Wendy's hamburger restaurants. He's an older fella. Cap rates are low. They're at 5%. He said, I don't have 20 years to wait for a 5 cap to pay out. They are willable and transferable to heirs. They do get a step up in basis. So it's truly a passive revenue stream, gives you monthly cash flow. The property I've got in South Texas is currently a little over 50 wells. I am not in the drilling business. I do not want to put any of my money at risk, but I like cash flow. That's why I buy the properties. The operators are going to drill another 200 wells. So moving forward, not only are my checks going to get larger, but the value will increase dramatically. I've had some properties double in value in the first 1 or 2 years. That may not be typical, but it is possible on a triple net lease mineral deed property. Historically, these have been bought and sold by the larger institutions. American Airlines, General Motors, the Harvard University. They like the cash flow. American Airlines has a lot of pilots in retirement for pension fund. This gives them that money that they need for the pension without any of the headaches, without any expenses. So somebody can 1031 in for whatever time period, 1031 out. You could even liquidate a portion of the interest. Say they've got $1 million and they need to free up $200,000 in 1 year, 2 years, 3 years down the road. Most of the people just hold this, and if they do hold the property, your tax burden is going to be tied to that mineral deed. So if they collect roughly 10 times their money back over the life of it, $1 million turns into 10 million. They hold the deed. Nobody has to pay the capital gain taxes. It's still tied back to the deed. But it does give a little more flexibility, gives you instant cash flow, very transparent. I have the title. Title can be verified. I have the monthly checks. So we're basically in the cash flow business tied to that mineral deed.
I like it. I like how Greg said, if you like it, then it's like kind.
That's right.
But mineral rights are fantastic. I've become a believer. I own a 75 unit apartment building, Class A. So it's a great building, and I love owning it. But their annual yield is ridiculously low, right? And you said something like, what was it? I don't have 20 years to wait on a 5% return.
Right.
And then so then my understanding, Bob, of mineral rights is they're a little more front. You're getting more money quicker out of the deal.
Correct. Yeah, it's more of a front end pay rather than having to wait, 10 years or 20 years. If you kind of compare the two, I've got a $500,000 house here in Dallas. The problem I've got with the house is my taxes that were $6,000 a year are now $15,000. My insurance that was $1,000 is now $3,000 or $4,000. So by the time you do the comparison, I'm going to have about $45,000 at $3,000 a month. You take out $16,000 on tax, part of that for insurance, take another part out to keep the yard and the pool. I'm left with about $12,000, and I've got $500,000 tied up. The same interest, if you get 15% on a mineral deed, I'm going to start off collecting $75,000, and 15% of that is tax free. So I'm getting a lot better cash flow. I don't have any of the headaches to deal with. I have no liability exposure. I've got a lot of upside. So any of the properties we buy are maybe 10 to 20% drilled or developed. Again, I'm not a driller, but we work with companies like Exxon and Chevron. They'll do all the drilling. They pay 100% of all the expenses, all the maintenance, all the upkeep. All the liability is on the operator, not on the mineral owner. So you're basically buying into an existing producing foundation of income. I've got the checks. It's pretty transparent. So those are the two pieces, title and cash flow. So it's pretty easy to look at and evaluate. Somebody, if they have a large exchange coming up, they could put in 50,000, 100,000. They like how it works, buy more. There are finite numbers to these. So some of these are only $1 million properties, 2 million, 5 million. And so once I reach that number, that property's totally sold out and closed out, and I'll buy more. So basically, that's what we're in the business of. We buy and resell those income producing mineral deeds. We have seen a downturn, of course, the pricing here lately. Now we're back up into the $20 range. But I have historical cash flow that I'll be able to share with everybody and show the upside on the properties.
I don't want to give away anybody on this panel's age or my own, but this is my third recession, and I have become a big believer in a bird in the hand versus pay me later kind of strategy. I want to transition over to Tim. So this is the moment that this is my second time having this conversation on a webinar this year. This is exciting stuff. If you're in the real estate business and you are not paying attention to what Tim's doing right now, you're going to miss one of the biggest opportunities to get a check from the IRS that we've had in 20 years for real estate people. This is a big deal. So if you're a real estate person, pay attention to Tim, and he's going to walk us through it. Would you like me to bring up your slides? Is that how you want to go?
That's fine. Go ahead. We're not very good at marketing. I think about Bob's story. It's pretty fun because, I've been around 24 years, very similar. Greg Larriman, I know well. We're both from Austin, Texas. I'm familiar with the oil and gas royalty scenario. So in a sense, this is a really coherent discussion for those that are on the call. And, this is for anybody that owns a real estate asset or anybody that serves or has a seat at a table for someone that's involved in real estate. So if you're a broker, I don't know who's on this call, but the talking point is if you don't want to sell, you need to call me. I'm going to come. Your introduction, Todd, was so good. We should probably hire you. That'd be great. But
I would love to come down to Texas. We can't even get out of our houses in Minnesota. I could probably eat at a restaurant in Texas next week. I'm coming. I'll be there.
Okay. Well, you're welcome. if you don't plan on selling your asset, even if you plan on selling, we could talk about that scenario. But basically, these are for people like you, Todd, that own 75-door apartment complexes, or people that have a portfolio of property. My clients are typically the general partners, the ones that have material participation, and to what you spoke to in the CARES Act. This is for active real estate investors, those that are considered active. The opportunity to carry back a loss 5 years. It's the big money in the CARES Act for those that own real estate. And so I'm going to break down a couple things. I'm going to try to tie things in with other things, but kind of the bold statement I'm going to make to the marketplace here on your webinar is that 70% of you are not optimized. You are just simply not optimized. You might feel you are. You might be offended by that. You might not want to find out, but it's a determination I can make at no cost with one piece of paper. So if you feel the conviction in my heart to try to serve you, then you should probably trust but verify. And that means trust what's been done in the past, but also look at it and review it and come to your own understanding of it. If you cannot name a person by name that is your quote unquote cost segregation expert, you don't have it, you're not optimized. The only reason you wouldn't benefit from what I'm telling you is if you don't make any money. Okay. Now, there's no cost to find out if you've got more than $50,000 in tax benefit. And that's probably around the range of the lower end of what I would do for you in any given tax year. What's more powerful than that $50,000 in tax savings is the opportunity to go back and think about all the money you've spent in the past 5 years and get a refund from the government. So I can give you examples of current clients that I'm putting under review again, and we're opening up deductions to carry back so they can get refunds from the government. Now that's kind of technical, but it's a 5-year net operating loss carryback, section 2303, 2304 in the CARES Act. This is not a new concept. Before the Tax Cuts and Jobs Act, you could carry back losses 2 years. Now you can go back 5 years. Okay. So I like that slide. Let's go back to that other slide so you can have my number. There you go. So everybody can see that. Maybe you just get my email. I don't know if we're covering that up with the pictures there. I don't have a problem with people calling me. You know, I'm truly in service to people. It's a due diligence item. So like all the other speakers, they're saying, let's find out, see if it's a fit for you. There's no cost to find out. Your CPA will end up agreeing with me. The only question is it a fit? And well, I can help you accomplish that in a very short period of time.
So Tim,
just a couple. Go ahead.
Tim, real quick, you can hit forward and backward at the bottom of your screen if you want to get a different slide.
Okay. Well, for those that want to contact me, feel free to take down my information. I'm going to forward, in 5 minutes, I'm going to cover some high-level ideas. So if you are a material participant, active real estate investor, and own assets, I'm going to cash flow anything that's been held for less than 15 years, typically, over $350,000 in basis. I'm going to price this correctly. Our firm's been in business for 20 years. We've done this more than anybody. We originated our entire industry. We have a greater knowledge base than our competitors. We practice business the right way. And I'm one of 5 people internal with the firm. We have 100 representatives across the country. If you know a CSSI rep, that's who's behind that person. Go to them. That's great. Please do your due diligence. If you're already working with CSSI, it's okay to reach out to your rep and make sure you're optimized. Like, for example, I have a client that I did 2 studies for, and I said, sir, I know you own a lot more real estate. Can we have your CPA send the remaining entities you own and all these assets and put them under review? Well, 19 of his properties generate a very conservative estimated $5.5 million benefit to him. He's paid over $7 million in taxes in the past year. He's going to get a lot of that money back. The result of my study will be more than $5 million, but that's what's possible. This also can work for businesses. So if you're a business owner on this call, maybe doctors and any sort of high net worth individual that might, be passive in nature, you can't look back. But you can carry forward losses. So there's active and passive considerations. We work through 1031s. We look at the remaining basis. To Robert's point, we have to have a certain amount of basis left over. So it works with 1031 as well. You typically want to hold your building 2 or more years because of recapture, and we can kind of maybe bring that up on a question and answer. But the idea here basically is you don't pay your taxes ahead of time. And to Robert's point, he likes cost segregation because it's a tax deferral. It's a substantial tax deferral. It's a choice. It's not controversial. We've done this over 28,000 times, never been overturned by the IRS. The question is how you get that done and who your trusted resource is for it. If you're thinking to yourself, you don't need a third-party expert, then you might want to rethink that, because your CPA will not get the result I get, and it will not be documented, and it will not be maximized. So, I mean, that's kind of hits a lot of high points. There's another aspect of the CARES Act related to qualified improvement property. That's really good news for tax professionals. Makes it easier for them to account essentially for interior improvements. We're still needed in a sense, but not as much. We look at the original basis in buildings. We look at your depreciation schedules. And with analysis, I can give you a very conservative estimate with one piece of paper. And, you know, I'm happy to take questions and that kind of thing. I wanted to be respectful of the time because we're at that 45-minute area. And I think a lot of the things we talk about kind of tie in across the gentlemen that are on the panel here. So this is an opportunity to kind of review. Let me just review this real quick.
Let's go through these slides. We got about 5 minutes, so go ahead.
All right, great. So what you see here on this slide is a foundational idea that cost segregation is foundational. The concept behind this is we're going to break a building down into its parts and pieces. There's 60 different assets with shorter tax life. Inside your building are 5-year assets. On the outside, you got 15-year assets: asphalt, landscaping, signage, fencing. Built on the breaking down of building components, you have the CARES Act. By the way, this cost segregation is 5,000 pages of tax code. Your CPA is not an expert on. We're an expert on 5,000 pages. We've been doing it for 20 years. We know more about it than anybody in the country. CARES Act. Well, now you can look back 5 years and get your money back. Okay. If you're active and you paid taxes in the past, your tax rates were higher, you could look at getting a substantial refund. That's kind of fun. That might be hard for people to really believe, but the government wants to give it to you because they want you to reinvest your money. They want you to hire your people back. They want you to buy another building. They want you to improve those buildings. They want you to invest in this country and make America great and that kind of deal. Tax Cuts and Jobs Act. This came out a few years ago. Again, we have a commercial real estate owner in office. He understands the power of depreciation. He says, you always could accelerate depreciation on your asset, but now I'm going to give you 100% of your benefit in the first year. So what you see here is a perfect storm of tax savings within the foundation of cost segregation, because at the foundation of this whole thing is calculations, calculating components of your building. Now, this weird thing at the top called TPR, I typically don't talk about this with people unless they own over 100 million in real estate. This is what I teach on when I do CPE to tax professionals. Now, unfortunately, the majority of tax professionals don't implement that. They sort of say that was interesting, and then they kind of move on. But if you own a lot of real estate, you're spending money every year improving your properties, maintaining them. You have roof repairs, etc. The TPRs involve how you capitalize and expense expenditures on your building. It all depends on what you did and when you did it, but there are elections like partial asset dispositions that identify the remaining basis in an asset you disposed of. So if you replace an entire roof, the roof itself that you replaced had basis and it's deductible. It's just often missed. If you do an LED retrofit, all the lights you ripped out have basis and you get a partial asset disposition. But the TPRs can also involve safe harbors and other aspects that are commonly overlooked that are very taxpayer friendly. We're interpretation experts to them. And the reason we're needed is all the examples the IRS has given, which is 280 pages of words, are built around a category or a concept called building systems. The problem is CPAs don't know what the building systems values are. That's what we calculate, and that's why cost segregation is at the foundation of this. So whether it's the Tax Cuts and Jobs Act, the CARES Act, the TPRs, or the idea that you could have accelerated depreciation on assets for the last 15 to 20 years, 70% of people are not optimized. So that's kind of what I would say there as it relates to foundational. This is what you're getting with the CARES Act, 5-year carryback loss option. It's a default position of the IRS. You have to opt out of it. You don't necessarily have to do it. You can opt out of it. So if we're talking about tax deferrals, we're always talking about deferring tax in the future. Now we can look back. So generally, you know, you might be concerned about amending your returns and stuff like that. We can get into that more. But if we do this year, you haven't filed your taxes in 2019, let's say, even if you have, you know, you might have to amend, okay, but it might be significant enough. If you haven't amended, if you haven't filed, you don't need to amend. Most building owners are sophisticated, haven't filed. I have a window of time. I need to help you make a decision. So this is a business decision. This is an accounting function. Make a business decision to not pay your taxes ahead of time. It's a choice. It's an option. And you can choose whether you hire me or somebody else, but you need to be informed. And the only way to get informed is to get analysis and let me look at schedules. This is an opportunity to review your portfolio of real estate. If you're a broker, if you are active principal and you're on this call and you're trying to learn and your team does not have a trusted resource they should, I do trainings for them. Most principals own their own real estate. And I'd say 90% of principals are not optimized. Y'all are the worst. Okay. So it's a lot of fun. It also can affect the deal, by the way, if you're a broker, because when you take into consideration the tax consequences of 100% expensing, when you're trying to pitch a deal or help someone understand the return on investment of that deal, the 100% expensing is a needle mover for many, many people. So that's kind of what my slides show. Carryback loss results in refunds for those that qualify. We can help you if you've extended, if you're on extension, if you've already filed, and there's no need to amend your returns in previous years. There's no increased risk for audit. So this again is just a servant spirit mindset I have to inform decision making and get yourself informed enough to make sure that you have a trusted resource that has a seat at the table for depreciation if you own buildings. You've got your attorneys, you got your CPAs, you got your insurance people, you got your broker relationships, you got your 1031 guy. But most people don't have somebody by name that takes care of them on depreciation and capital expenditures. So that's kind of, hopefully that was an appropriate time.
That was fantastic. Thank you. I want to drive home a point for Tim that I think a lot of people in this country are missing, and I completely missed it until a week ago. Somebody made me aware of it. You can buy a property today before the end of the year, do a cost segregation study on it. If it generates paper losses for you and you're a qualified real estate professional, you can actually use it to carry that back and get old tax money you've paid back in your pocket. So the last time we could do this, was back when I was a tax geek, and I worked on a project for a guy now that we'll be friends for the rest of our lives. But we looked at his portfolio. He bought a couple things. We carried back. We got him a check from the IRS with 7-figure check, right? So he's like, I've been paying taxes for years. I've never had them send me money. It's cool. And it's a real thing that's available today because of the CARES Act that you can do that. So you need to call Tim, but you can even still do it even if you don't have a portfolio right now, but you got to be a real estate professional, right?
That's the key. You got to be active. And to your point, I want to make sure that there's like a technical aspect of that because the company would, choke me.
Well, that's why I said it.
So, but I do appreciate it. I think you had mentioned in the past you're a partner at BDO.
No.
Even what was the firm you worked at?
I'm not going to say what firm
Okay.
I used to work at the national office of a big firm.
Sorry about that.
It's all good.
I'll play ball there. But if that client had bought a building in 2019 and closed before the end of the year, for certain we could carry it back. Okay. Now you buy a building in 2020 that's going to relate to the 2020 tax. Again, it would be qualified for net operating loss, but he's going to have to wait until he files his taxes in 2020. So I just want to make that clear. Yeah. You can take a loss from a 2019 acquisition and carry it back because all roads lead to Rome as it relates to your income as an active real estate investor. My clients are those that hold buildings for more than 2 years. So if you have a plan to hold a building for 2 years, or you've owned a building for more than 2 years, or you have any assets that exceed 500,000 in basis, let's say, I don't care if it's 10 or 15 or 1 or 50 residential homes. It could be $100 million real estate property. I work with large funds, billion-dollar funds, and then just normal people and small businesses. We didn't even talk about small businesses, but if you serve small businesses, there's a grouping election that's commonly overlooked. It's a proactive tax consideration. Most CPAs are not going to put that in front of a client. As a building owner, you're responsible to understand the benefits afforded you. You cannot rely on a tax counsel to put ideas in front of you. I'm going to go to them with confirmation, okay? But you need to inform yourself. That's my message to the marketplace.
Well, we're down to 5 minutes left, so I want to just go around and get final thoughts from everybody. If anybody in the audience wants to ask another question, get it out there. I think we've covered everything. And let's go around the room. Let's start with Bob Baker. Give us a quick 1 or 2 minute recap or any last minute things you want to mention.
Okay, sure. A lot of times we'll run into guys that are maybe running short on that time window. Maybe an inspection or something has fallen through on their identification. Terms weren't met. The numbers weren't agreed on. I can be a safety net. So I can actually do the transaction in one day. I'm the closing agent. So there's no origination fee. There's no title fee. There's no fees to enter. Someone told me I had a fellow that did that 12 years ago, had 615,000, parked it. He's collected about $2.5 million so far. He had 2 days left. So I can close. All I do is execute the documents, transfer the funds, constitutes our closing. I worked with most of the accommodators out there. Worked with Greg for a number of years. He's very much an expert. I refer to him if I have a question on a 1031. He does know the business inside and out.
I'd like to also just reinforce Greg's expertise on 1031. He's a friend of mine, personal friend. You're not going to find a more knowledgeable man in the industry. Like you said, 24 years of experience in the business. I think what they're doing beyond competitors maybe out there is they can handle larger deals. It's done correctly. And Greg knows, he's seen it all. Greg's seen it all. And he's just one of the best and most genuine people you'll ever meet.
Well, Greg, then it's to you for sure.
Thanks. Yeah, the feelings are mutual. I really like and respect everybody here. When Bob said, yeah, they can act in one day, that reminded me Monday, the closer called me and the people were at the closing table and she said, hey, Greg, these people are closing their deal right now. They just said they want to do a 1031. I said, okay, I need to have one conversation with them. You need to email me the contract and the title commitment. And I did that. I made sure they understood the high points. I qualified them to make sure this was right for them, and then got the contract and title commitment to my staff. And 45 minutes from the time I got the initial call, we had our exchange documents at that closing, and they still were able to close that day. So yeah, I really am proud of our back office that supports me. I answer the questions, and then we've got a good staff that does the paperwork, and we do it fast. And we've done 180,000 of these and had 0 claims or 1 penny lost. And the qualified intermediary industry itself is not regulated. We're regulated because we're owned by Stewart Title. So
that's a good point. Yeah. You know, the last recession, or it might have been the one before, a lot of people lost money by not having the right QI.
Right.
Cool. Okay. Okay, Robert, as to you, final thoughts?
Yeah, well, you know, look, I think the big thing for us, you know, we want to help agents grow their practice. It's not what you can sell the property for. It's what you net is the most important thing. We want to be able to offer each and every one of you as agents a turnkey opportunity to help sell yourself. I mean, if you go to a cocktail party or meet somebody and they ask you what you do, instead of just saying you're a commercial real estate professional, like a lot of other people do, what differentiates yourself with everybody here is say, look, I specialize in helping people defer capital gains on the sale of their buildings, and I'm a professional commercial real estate professional. So if you lead with different ways of, you know, talking to people, you know, the next question out of their mouth is, how does that work? You know, so you want to be able to offer these services, you know, 1031 exchange, cost segregation, all the things that you're learning here today. Our goal is to give you these options to help support you, have a team approach, and help you grow your practice. That's what we're all about. So I welcome you guys to learn about the DST, and all the people here have great information. So most importantly, we're here to help you, and we're here to grow your practice, because again, we're all in it to win it together. I hope that all makes sense to everybody.
Yeah. That's awesome. Tim, take us home.
Yeah, well, I appreciate that. You know, the spirit of what Robert shared, I think, you know, I'd hire him too, by the way. He probably is not looking for a job. I'm thinking he wants you to call somebody else. What was his name? David. So, man, it's the same idea. Really, when I met Greg, it was the same thing. I said, we're in the same business. We're talking tax deferral. Here are different strategies, and it works for certain people in certain scenarios. The idea of being a broker, if that's our audience, there's a differentiator on a listing, like was mentioned. You know, don't be offended. I don't know what kind of audience we have, but it's a competitive industry. knowledge matters, but it's your spirit. It's all sorts of other things. And when you try to help somebody, if you can't help them with the thing that you're good at, like I'm only good at a couple things. I only really know about a few things, but I'm going to try to help you in some other way. If you can connect him with his future wife, then 5 years later, you're going to get a listing, So, just don't be selfish about it. People are looking for trusted resources and relationships. If you send somebody to Bob's team, I'm sure that Philip or David does a great job. They've been at it for 24 years. If you go to Greg, you're going to be taken care of. It's kind of the same with me. All I'm doing is exchanging information and getting something very specific done. You can trust someone that's new to that game, or you can come to someone that's been doing it for 20 years, like Robert, like Greg. And it's important for you as a real estate owner to just understand your options. So don't be hesitant. There's no cost to talk to me. Thank God I wish I could charge you $400 an hour. That'd be great. I've got friends, but I haven't figured that business model out yet. But basically, if you call me or touch base with me, I'm going to give you my heart. I'm going to educate you on a narrow thing, and then we're going to help consult with your CPA to make a business decision in your interest. It's going to happen pretty quick. It's not very complex. The concept is don't pay your taxes ahead of time. You need to hold a building for 2 years, just in summary. And I'll leave it on this because you asked me to carry it out. I pay more in taxes than most of my clients, which is really outrageous. I left this out, but now we can offset 100% of your income if you own real estate. It used to be only 80%. Now it's 100%. So it's just like crazy amounts of good news for you. My clients that own a lot of real estate that make money shouldn't really be paying very much in taxes, especially if they continue to acquire. If you save money on taxes, you have more capital to invest in more real estate, if that's your business. So one idea, it's a bright idea. You have two choices. You can write a $100,000 check to the IRS this year because that's what you normally do. Maybe you write a $100,000 check every quarter, $400,000 a year. I'm sure that's fun. You're super blessed. Enjoy that. Thank God for that. But if your CPA came to you and said, hey, look, you pay $100,000 in taxes every year. We don't want to get in trouble. We want to be really conservative and do the right thing. Why don't you write $1 million check today because you're going to pay $100,000 over the next 10 years? Would any of you sign up for that? Ask yourself, would you write $1 million check today because it's likely you're going to owe $1 million over the next 10 years? Heck no, you're not going to pay that ahead of time. So I hear crazy things like, well, you can cost seg if you like, but it's really just a timing difference. Well, yes, it's just a timing difference. When do you pay your taxes? You can defer them with cost segregation, and then you can further defer them with 1031 or the trust that was explained to us by Bob. So, that's me kind of summarizing the whole deal. I appreciate you, Todd. You're the appropriate panel guy here. What do you call that? Because you kind of know a little bit about tax. You're putting the pieces together.
Not many webinar hosts are tax geeks, but
well, I need to find out if you're optimized on that 72-door apartment complex. That's what I'm thinking.
I'm willing to bet we are. Just a guess. But hey, this was a great panel. You guys took a topic. Frankly, tax puts a lot of people to sleep. We still have just about everybody online that was online for the whole time. So kudos to all of you for keeping it interesting and fantastic. To the people in the audience, I will send out slides if these gentlemen will let me. I'll send them out to everybody that was online. I'll also send you a link to the YouTube video, so you'll have that. You can forward that to your colleagues. You forward that to your friends or rewatch it if you want to. I'll get that out there. It'll be about an hour probably before we get that live. Any other questions? You have my email address because I emailed you your link to log into this, but I can get you in touch with any of these gentlemen too if you missed their email address up on the screen. Guys, I'm going to play a short video. You're welcome to log off. Thank you so much, and I look forward to doing this again because this is a good group, and I think frequently we can touch on this topic and continue to spread the good words. Thanks, gentlemen.
Thank you.
Thank you, guys.
Right.